This is a Momentum Media production.
Inside Commercial Property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
G'day, how you going? Phil Tarrant, co-host of Inside Commercial Property with Scott O'Neill, Director, Rethink Investing. Scott, how you going? Well?
Yeah, very good. Thanks, mate. Yourself?
Getting by, struggling property investor, struggling commercial property investor, trying to make headway in this tough market with interest rates going up, mate. The performance of my commercial property, which we've been chatting about on this particular podcast that we acquired, leveraging the good services over there at Rethink Investing a few months ago, the numbers, the P&L looking very different now. These interest rates keep going up.
Yeah, it keeps you on your toes, doesn't it? All the the rate rises, and it's something we all knew that was coming, but it's very different when it starts hitting, doesn't it? Like we've all, I think everyone got lulled into a false sense of security, going, "Yeah, rates they're never going to go up. Debt's high. You can't raise them. Here we are. They're higher." And I can see there's a lot of people changing their investment behaviour at the moment, and particularly with certain things like with the Queensland land tax rulings and that. So all of a sudden you see all these houses in Logan and Ipswich and places like that up for sale. So it's people are selling as a result. And it's just a moment in time, isn't it? Just part of the cycle.
It is. And, a lot of residential investors are also commercial investors. A lot of commercial investors have some sort of exposure to the residential market. Horses, of course, is really, but that's a good point you make around Queensland land tax changes. And I've been having a conversation about, do I liquidate all of my Queensland assets, because it's still a bit of an unknown exactly the impact of increase in land taxes for me. I don't know, you got any guidance? I know there's a commercial podcast, but while I've got you, and you're pretty good at the residential stuff as well, is it going to change what you're doing in terms of your Queensland assets? You got any resi stuff up there?
Well, look, I always invested similar to what I do in resi with commercial. So I look at the cash flow. So now that there's a difference in cash flow due to potentially more land tax obligations, you've got to just factor that into the equation. If an extra $2,000 or $3,000 or whatever it is for this purchase is going to make it not worthwhile your purchase, then there are better states. I know we're quite heavy in WA at the moment. I think there's a lot of potential in that market. And, Queensland's one market. There's so many others. It makes it less attractive, but it's still got a fantastic long-term future. Like particularly some of the markets are in southeast Queensland where the Olympics and all that are going. Brisbane's the third largest city. That's not going to change. These cash grabs by governments, they'll probably keep coming up in different forms over the next decade. Like there's all this debt, and there's got to be a way of recouping it. And the way the states and the federal government sort of operate without each other, sometimes it's there could be a bit more of this type of stuff. So keep your buffers in place, but it's just another part of potentially factoring in more costs. So you got to probably put that into the price. Or I'm seeing a lot of articles go up about rent's going to go up because investors are going to have to push it back onto the tenants. And it's not good for tenants. Like that's probably going to be the biggest repercussion out of this, that tenants are going to pay more because owners are pushing costs back to them. Plus the interest rates have gone up too. So it's all going to be very interesting.
It will be. I've been sort of semi-vocal about this. I don't think it's very good policy. Look, I'm not someone that lives and sits inside of the Queensland government. I'm not a paid government official. But I think what they're trying to achieve with this, and probably to try and normalise or make housing more affordable for owner-occupiers, it's just going to have probably the opposite effect. And you think about it, Scott, all those people who have bought owner-occupier properties in a market which could potentially go south because it's structurally going to go south because of government intervention in taxes, I don't think they're going to be pretty happy, number one. Number two, you're struggling to get yourself a rental property in Queensland as it is right now, particularly in those areas, southeast Queensland you spoke about. There's a huge shortage. Three, it's got to disincentivize people to move intrastate, and then also as borders open, it's really going to make Queensland a less attractive proposition for new migrants. So I don't know. I reckon they might get a quick cash grab at it and then sort of retreat backwards because the economic impact long term will be considerable and substantial. I don't know. We'll see how it plays out. And that's on the residential side. It doesn't impact commercial property. is what we understand now.
Not so much because, I'm yet to get the final result from my accountant as well. But he's basically saying the impact, and I own a lot of property in Queensland and outside of Queensland. So if anyone's going to get impacted, it's myself. But he's basically saying because I've siloed each deal in different trusts and separated things to different entities, the impact's quite minimal. And remember that commercial tenants pay. It depends on the lease, but a single holding of a company land tax amount goes to the tenant. So, if a lot of it gets passed on to the tenant just automatically, and that doesn't, it's, it doesn't include your home, your principal place of residence in the calculations as well. So it's investments only. So I'm yet to see the impact, but I'm told verbally only yesterday that it's very minimal for my commercial properties, which is good.
Well, it's good news, and maybe we can get a tax specialist in to have a chat with us about this specific thing. And again, that's another sort of third order impact of this. If commercial property investors are having to pass on any land tax increases to the tenant, well, I'm sure your small business councils up there aren't going to be too happy about that, saying it's another gouge from property investors making it hard for people to conduct business. So these are the second and third order impacts around these things. I don't know, still wash out and wash through. I don't know whether or not I'm going to be selling assets up in Queensland, but I tell you what, I'm not actively buying up there now. And to your point, there's probably other markets which are better. And Scott, one of the great things about this particular podcast, we've been at it now for a couple of years, sort of steered through the COVID pandemic. And as we emerge out of it, the market today is very much defined by rising interest rates. I spoke about my commercial property, which is a really good buy. It's a good asset. My interest rates already spiked 2+%, 3%. This is the nature of the beast. Fortunately, with commercial properties, there's usually a lot more fat on the income side or at a P&L level where you can buttress a lot of these cash impacts. You might not be adding as much to your bottom line, but you're probably not going to find yourself in negative cash flow. That's a very general statement, but it's a reality of investing in commercial. On the property that you guys secured for me, which is in Western Australia, I think by memory, we were sort of had about $40,000 a year as positive cash flow after all expenses around it. Like that's going to get swallowed up pretty quickly on interest rate repayments. However, it's got to go a lot further before that's actually going to turn into a negative situation for me, correct?
Yeah, that's right. So like in your case, you probably lost potentially 10 grand of that 40. So you're still, 30 odd ahead. And that's what the beauty of it. Like you said, there's fat in the income. And that's the biggest difference with commercial investors to resi. Like if you've got leveraged up and you've got 20 plus, middle ring suburb houses, you've gone into quite a tight cash flow situation. So you need a good job to keep your portfolio in commercial. It's you've gone from extremely positive to still positive. And if you're negatively geared, I've never really heard of anyone go negatively geared for commercial, like unless it's vacant, and that's a different beast. But yeah, it's a low debt world. Like I saw some articles online from one of the big auction houses. They were quoting to the Australian Financial Review, I think it was them, basically saying why they're selling assets at 3 and 4% when interest rates are 4 to 5%. And they just said they're cash buyers. These are guys buying $4 or $5 million servos and childcares and stuff like that. Like they're not what I'd call great deals, but there's people just with cash that don't want to sit it in the bank, because we all know that if you sit it in a term deposit, you lose money. There's no way you can get ahead through a term deposit. So you have to invest. In this high inflation environment, your money will devalue so quickly if you don't leverage into something. Then it's almost like this is why an evenly geared situation is a lot better than the alternative. So everyone that's got substantial amounts of money know this already. This is why they invest. Like you've just got to keep pushing through. And look, I think the rates are going to come back down, I reckon mid next year, maybe a lot earlier than people think, because what they're doing to the economy is going to hurt the mortgage belt of Australia. Your middle income earners are going to get hurt. Like the lower income are going to get hurt from the inflation, like at the grocery, the Bowser, all that. But all the other guys that are trying to give it a go are going to get hurt by this, and that'll stop spending at some point. And there's talk of some of the external factors, with costs starting to drop a little bit. Obviously the war in Ukraine and all that's just not helping, but cost of fuel starting to come down a bit. So these are going to help with, the inflation equation. And if that happens, then and the economy's got a technical recession, then you've got to start boosting productivity again. And the one way to do that is to at least stabilize the rates and then probably drop them down because, people are going to get hurt otherwise.
It's the machinations of how the Reserve Bank of Australia and the governor operate to steer the economy in the right direction. And there's a lot of discussion, Scott, that there's still a lot of spending happening, right? And there's this sort of knife edge of taking the economy into the Christmas period and people still having an attitude and aptitude towards spending, but not overspending. And I think that's going to be the circuit breaker for this particular rate cycle is, will they give sense for some level of sustained confidence with Australian consumers to spend over Christmas to support retail and hospitality and everything connected in with that, or they'll try and apply the brakes even further. Who knows? It's a tough job for the RBA and the governor to get this right. Whether or not we'll see rates coming down in middle of next year, maybe. It all depends on a number of different factors, particularly what's going on in the US and what this impact of these rising rates will be. The way I view it, the way I see it, the way how I'm acting and operating around it is I'm going, well, how does this impact me as a property investor? I've got a pretty good job. I'm able to weather rising rates, even if my resi portfolio is negatively geared. To your point around cash buyers out there sort of getting assets, commercial assets at 3-4%, which is less than what the current interest rate is. That's some smart land banking going on right now. This is that counter-cyclical investing that you hear about. If you can pick up these assets, they're not distressed by any means, but I would say the heat on the commercial market's probably in line with the heat in the residential market, and that is it's come back a little bit. I like your sense of that. As the commercial market slowed down, and these people are just buying properties today, which maybe 6 months ago would have been a very different proposition, and they're getting ready for the next cycle. Thoughts?
Yeah. Look, a couple of things to your points there. Like the spending, because I'm over in Europe still at the moment, and I'm trying to book a ticket back, and the cost of tickets are about triple, and there's nothing available. So I'm on a Greek island at the moment, and it's never been busier talking to the locals. So this is the problem that we're seeing. It's not a problem, but people have money. I'm like in a tourist area, and they are packed. Everyone's spending. All the airlines are full. Like this. Inflation is really getting driven by people because they've got all this money that they've probably stored for the last 2 years. And that's why it's going to take probably a little bit longer than us commercial and property investors want it to sort of unravel, because people are still spending. So it might keep going beyond Christmas, but they're going to run out at some point, you'd hope, or at least lose the confidence. So then at that point, that's when the interest rates will come down. And as an investor, to answer it, like the smart investors are buying now. I've just personally, I'll be settling in a month, my largest ever purchase. And trust me, I was nervous, as I always am when I buy a property. I overthink things, and I basically just thought it's a lot better to buy now than it was 6 to 12 months ago. Like you're getting a better deal right now, and I don't care what the interest rate is today. I probably care what it averages out over a 10-year period. That's more important, not what it is today, because it's going to be different next year and the year after and the year after. So it's better to think about long-term average interest rates and then look at your long-term average rental growth and look at property. Like we mentioned in the last podcast, what money does over time. It's not about the snapshot of today. It's what the average looks like, and you can sort of make better decisions that way. But yeah, if you've got cash available sitting in a bank and you're waiting for this perfect time to invest, you'll never get it, because if it's really good, you're going to pay 20% more than today. And if you just got to pick up the right deal. And and I'm seeing that because we're like, as a business, we've never been busier. I thought it would slow down, but we're getting more inquiries now than we did 6 months ago. And I think it's a lot of that transition away from the residential, or I think stocks are taking a pretty big hit at the moment. So a lot of people are not investing in stocks at the same level as they were. So commercial's a bit of potentially a safe haven versus stocks.
Yeah, it's well observed. And we need to remember that the economy is still performing pretty well here in Australia, right? Like, it's not like we have significant concerns about the economy. Unemployment levels are still at record lows. I think they're starting to go back up, and I think this is a natural equilibrium taking place. The economy is still performing pretty well. And, if you're a commercial investor, guess what? Your investment is intrinsically connected with business and the economy. Commercial premises are inhabited by income-producing businesses. And if economies are still performing well, the economy is still performing well, commercial markets often run in lockstep with that. The question I have for you, Scott, and it's a bit of a hypothetical, are you better off having chunks of money sitting in offset accounts, offsetting residential investment debt, or would you be plugging that money if you had it into commercial purchases right now?
Oh, look, if you
and
understand
I'm thinking about myself, by the way, right now.
Yeah.
Yeah.
Yeah. Well, look, I always answer these questions just exactly what I would do myself. That's the only way I can answer these types of things. I'm not what do they call them, a financial planner or anything like that. But as an investor, I understand what inflation does to money. So we've both got a lot of time on our side to invest. So I would be leveraging into good quality assets with land component, and just make sure your cash equation's good, cash flow equation, and you're going to make a lot more money doing that than paying debt off, because money is going to keep devaluing faster than what we all think for a long period of time. So if you've got $1 controlling $4 in the market with a couple of zeros on the end of it, you're going to do well over the long term. That's what any good investor in property understands. So just make sure you can cover your interest obligations, and then if you're comfortable with that side, and you factor in your other income, like you've got your job or your business or your rental income, you've got to look at the full picture and then put some safety buffers in place. And if you can cover that worst case scenario, then keep investing. And that's what I'll be doing as long as I can, because it's like growing a business. You don't stop growing the business if you think it's going to do better. You keep pushing forward, and that just brings extra diversity. And you'll find that you just need to keep it a certain LVR on your portfolio that the banks are comfortable with. So then you can refinance quickly if there's a worst case scenario that comes up.
Yeah. And this bit of feedback we had, and it's good to, and please keep the questions coming through. info@rethinkinvesting.com.au is where you need to send them. And Scott shares them with me, and we have a good chat about them. And I've been thinking about this question myself, and I get a lot of residential investors, even commercial investors, asking me the same question. And that is, with these rising rates, increased rates, therefore this P&L impact for commercial investors, has the shine come off commercial investing? Now, you're saying, Scott, that inquiries to Rethink Investing is as strong as ever around, and I'm thinking mainly around commercial property. So that would indicate to me from one source that the shine is certainly hasn't come off commercial investing. What's the attitude of investors right now? Are they going, okay, this increased rate environment is a moment in time, it will probably come back a little bit potentially, so therefore buy now? Or, is commercial investing not the place to be?
Well, the honest average opinion that I'm getting from a client is they want a good deal. They're ready to invest. They've got the cash. I think my clients are quite educated. Like, they do listen to the things like the podcasts, read articles, and they've probably already got a portfolio of resi as well. So they get investing. So there's, like, you don't need to explain to them that this interest rate is going to be the exact same for the next 20 years. So they understand that's going to go up and down, but your rent will increase over time. As your rent increases, so does the asset value. So just sitting on the sidelines costs money every year as well, not just in cash flow, because you're still positively geared, but you're going to have to pay more for the same asset next year because the rent's gone up 5%, for example. So there's a cost of sitting out, and we're busy because I think there's more people going, well, residential doesn't solve this cash flow problem. And now I've been forced the hand. So we're collecting a lot of that inquiry level, and people want to invest, and they understand there's capital growth in commercial. So this whole idea that, you need a super high yielding commercial property to justify the purchase, I think that's fading. That's the old school residential salesman saying, oh, you don't get any capital growth in commercial. But we all know that's not true. And that's why you're there for growth as well. It's not just cash flow. You'll see on your asset, it'll grow every year. unless there's a massive shock to the economy where rent values halve or something like that. That's the big kicker. If you see rents drop, that's when you're in trouble. Interest rates going up and down, that's just small fluctuations to your P&L. That's just like any business. That'll go up and down. You deal with it for the good and bad. But if rents drop, that's when you know the economy is struggling. And there's just no indication on earth to say that that's going to happen because build costs have gone up. You know, the vacancy rates are dropping across the country. We've got a very strong economy compared to what we're used to. And that's flowing through into the commercial markets and businesses. The ones that have got through COVID are all doing quite well. So, yeah, I think it's all pretty positive and investors are seeing that. And you're getting a better deal than you did 6 months ago. So that's why transactions are happening, because you can kind of see that already. Like, we're already benefiting from these rate rises. And will the deals get better in the next 6 months? I don't think it's going to change much. Like, there might be 5% here or there on a deal, but like, you've got to remember, commercial investors generally have low debt levels and they've got nowhere else to put their money. So they're not desperate sellers. There's no, like, I have not bought a bank sale ever in commercial. I'm trying to think if I have or not. No, it's normally just, like I've mentioned, an old guy selling down to clear his affairs, or a divorce, or a developer trying to pool his funds to another project. Like, that's the sellers in a commercial market. They're not stressed mums and pops who are redlining on their mortgage. So you don't get the big discounts people hope for.
And that gives a sense of stability of the market. You spoke about shares, Scott. Not a lot of stability in the share market at the moment, to the point being, is the economy in rude health? It's pretty healthy right now. But really it comes down to asset selection with commercial properties. Are you going to see wholesale drop in rents? If you were to see that, which I doubt you will, it would probably be in specific asset classes rather than a holistic thing. And, the property that I've secured over in WA through you guys it's a logistics warehouse. So the future is very much orientated towards there always being a demand for that particular type of asset that I've secured. Maybe different, once the world goes completely electric, is there going to be a demand for petrol stations, for example? You may see wholesale shifts in rents on that basis, but comes back to asset selection. And that's been very much, Scott, the thrust of a lot of our conversations on Inside Commercial Property has been about the who, what, when, where, how around investing. And I think we're doing pretty well in that regard. So it scores pretty well. We get pretty tactical sometimes. Sometimes we get a bit philosophical and talk about the economy. We've done a bit of that today. But some of the feedback we do get is, okay, well, what happens once you've bought something? What's next in the equation? We've got some really good feedback only this week around that, where people are going, hey, guys, keep up the good work, but can you start talking about the other bits of commercial property? And I think the opportunity for us is to start steering our narrative and our focus towards those type of things. Stuff like, how do you go about revaluing a property? How do you go about extracting equity from that property? How do you go about improving those properties? Manufacturing equity through different things you can do inside a commercial, like you would do in resi. How do you go about releasing? How do you go about improving lease terms? And importantly, when's the right time to sell? You spoke about when the drivers for selling commercial property is often very different to the drivers for selling a resi property. And I think you crystallize that really well. So that's where I want to take our conversation over the next few months as we get in this pathway of talking about these type of issues. And when you look at the rising rate environment, a lot of those increased costs, whether they're inflationary, whether they're to do with taxes, will be picked up by the tenant inside a commercial property. But there's other ways that you can add value to your assets. And maybe that's where we can concentrate particularly today. If you wanted to get an uplift of capital growth, manufacture greater equity in your commercial properties and or manufacture better leasing terms, where would you start with those things?
So, yeah, look, it's a good intro because, Phil, I've been reached out a few times lately. Because we've probably got, thousands of guys listening to this that now own commercial properties.
Guys
so
and girls.
This is not
lots of girls listening as well. We've got to get some more girls on. Ladies.
100%.
Yes.
And it's right. Like, so this is for everyone, because you and I can start talking about it, about, what happens after settlement. And, to answer your first question, revaluing. And I encourage any of my old clients that are listening, reach out if you're in a position where you're actually looking to refinance or revalue. We can help. And this is the advice I'd get. So depending on where your asset is, there's certain valuers in town that will be more bullish. Like, it's all fair market value, but when you get a valuation on settlement, they can be very conservative. So some are fair and some are not fair. So we would go to the ones that are fair, that will give you a fair market rate. And you can then just check to say, look, would this company be workable with your bank? Are they on the panel of lenders? And you can actually refinance and you can renegotiate your interest rate at that time as well. You might even shop around to the other major banks or some of the second tier guys. Like, it's a good time to probably try to get a better rate, because that's what I've done on my portfolio, because I'm just buying a new property. I just looked at all my rates. They've crept up more than they should have. So I've just said, look, if you want to keep my business, take some money off. And they came back within 2 hours and shaved about 0.4% off. So, with my debt levels, that equates to quite a lot of money.
Sounds like a European holiday.
Yeah, exactly. And I'm terribly lazy with this stuff. And I'm sure many of my listeners and clients are as well. Like, go to your bank, ask for that discount, because you're probably going to get it. And when you're talking millions in loans, then it's the easiest money you're ever going to make. So, first step, look at your bank, talk to them, see if they can better the rate, and then revalue. Because if you've held a commercial property for more than a couple of years, you're probably sitting on a very big chunk of equity, like could be 20, 30, 40%. So a lot of my clients are doing that, and they've found they've got another deposit handy. So it's a really good thing to do. And especially if you've got nothing else to do and your property is just idling away and you're in this kind of plateau stage of your portfolio, like, you got to work your loans and work the revaluations, because you might just revalue it to a lower LVR. Even if you don't want to pull money out, like, you may have went in at a 70% loan, revalue it, you might find there's 20% equity, go back to the bank with a 50% loan rate. And because your lower debt level is more conservative, the banks might value that business more because it's a safer loan. So then you can go to all different banks and, you're not even losing equity. You're just going on with a lower LVR for the bank. You might get a longer P&I term, or, there might be just some benefit to moving. They might pay all your fees to move over to a different bank. So, it's revaluing is something that I'm incredibly lazy at doing, because and I'm sure you are too, Phil, because you've got a lot of properties. It's a big effort, but you got to do it. And you almost need to put it in your diary to do it every year. And
I dread it. I hate it. I absolutely hate it. The last time I did a big podcast around a series of them, where it was one bank in particular who I had a horrible experience with them. They've got gold and black in their logo. It was absolutely appalling. It made me physically angry. Like, I wanted to punch people. Right? It was such a soul-destroying experience. I was on hold for an hour and a half one day, dropped out because I think it was after it become 6 o'clock and they all went home. Tried to get the next day, exactly the same thing happened. Tried to get another day, exactly the same thing happened. Finally tried to talk to someone and they went, no, not doing anything. Finally called up I went through their sales channel and I just went, look, you're going to lose me as a customer. You've got to sort this out right now. And I've got some big complaints around this. And I fought tooth and nail to be able to, I think I shaved maybe 0.6, 0.7 off probably about 6 loans with them. They were really reluctant to do it, right? They made it really, really hard. Whereas other lenders, I had such a good experience with them. And I think of Macquarie Bank, where I've just called them up. I normally sit there and it's like, when was the last time you walked into a bank branch? Like some time ago, right?
Probably 12 months ago.
Yeah. If I go to a bank branch, if I have to go to a bank branch, which I hate doing, like, I'll be walking along there, and I'll be gearing up, getting ready for a fight. Like, it's such a negative experience having to walk into a bank branch because it's so soul destroying. Hence the reason why people use mortgage brokers. But I've got to G myself up to actually go through the process of knowing I'm going to have to fight for probably a couple of days to try and shave some points off my interest rates. That said, though, it's probably the most dollar productive bit of work I've done that week, because literally I think I did it. I probably shaved, 20 grand, 30 grand in interest costs over the course of a year. And I was like, okay, well, I wasn't happy about doing, but other banks like Macquarie Bank, I called up and went, hey, look, I'm getting this particular rate with this bank for exactly the same loan inside the same trust. on these terms, and they within like 5 minutes they went, yeah, no worries, we'll beat it by whatever, and in place, happy days. So I'm lazy around it because I hate doing it, but when I've done it, I feel quite satisfied with the process of doing it.
Yeah, and like they always say, property is a game of finance. So we spend all this time choosing the assets and talking to tenants, making sure it's a good deal. But you've got to have a good deal with finance too.
Yeah.
And right now the deals aren't as good because of the interest rates. So there's more of a reason to actually look around, check if you're on the best deal, because banks will try to keep your business as well. And like I said, with commercial, there's different levers you can pull. So if you go in with lower LVRs or get off a lease doc loan back onto a full doc loan, you're going to save money. And you just wait for a couple of years, then go again, do it all over again, and just keep improving that little cost center.
Yeah, if you could explain this for me, because you've said it a couple of times and maybe some of the listeners don't really get it. You're saying improving the LVR term. So really simply, if you bought a commercial property for $1 million and it was a 70% lend, which is pretty typical for commercial, it means you've thrown in 300 grand plus other costs, so like stamp duty and all that sort of stuff. So the bank sees you with a particular risk profile because your loan is at 70%. So what you're talking about is saying, well, that property may have increased by 50% over the course of a number of years. So it's now worth $1.5 million. So it's just really calling up going, hey, I want a cheaper rate because my risk profile is a lot less than what it was when you first issued me this loan. Is that pretty much the concept?
Yeah, so your rent would have gone up. So remember, your interest rate cover would be higher. So you're getting more income versus the interest you're paying. So because the rent's gone up, your asset value's gone up. So using that scenario you use, Phil, if your property's gone from 1 to 1.5 mil, you've got $500,000 equity in there. So you don't have to draw all that out to splash on another property. Most people would, but if you don't, you just go, well, I'm just going to go back to the bank. I'm going to leave my debt at 500 grand or 700 grand if you use that. So you're going to be under 50% LVR in that scenario. And banks will love it because you'll service every calculator they've got, and there won't be any knockbacks from the banks because it's a conservative position that they'll probably, every credit approval team would sign off on. So you can just shop around with that lower LVR and get a better deal. It's particularly important for those who've gone and redlined into a deal and maybe their income's dropped, or they're like lease doc loans. Remember, a lease doc loan is one where you've got finance based on the lease on the property. So you're not personally backing that deal. So you might pay a higher interest rate on a lease doc loan. And I always tell my clients, get the lease doc loan if you can, because it's quick and easy. But then long term, you want to refinance off it, get into a more conservative lending position, and you'll save interest. And there's just a lot of ways to skin the cat.
Yeah, it's a lot of ways to skin the cat. And if you're going to go down the pathway of doing this, be armed with some really good comparables from other lenders, whether you're trying to sort of reprice an LVR position or just get the bank to make their interest rates more competitive. They're going to want to know what else you've got and what other people are offering them. So don't go in with idle threats saying, hey, if you don't give me a cheaper rate, I'm going to move. Most of the time they're going to go, well, we're going to go on what are they offering you? So you need to be equipped with this stuff and actually have tangible examples of how you want people to meet it. And there's a real two-speed market in terms of what banks are offering new customers versus existing customers. So know what those rates are for new to bank business. And you should be trying to chase comparables around that as well. Why shouldn't, this is the big issue, why should loyal customers be penalised on their interest rates when new customers are getting more preferential interest rate positions? So just do your homework first and get stuck into it. And that's a big part. It's revaluing and refinancing. The smart investors now are sort of getting liquid where they can. If you do have those big chunks of equity and you can realise that you can always park it in offsets on loans, depending what structure you hold them in. But another great way to, post-settlement realise a greater outcomes inside of your investment is improving the actual value of the property itself. Let's not talk about renegotiating or improving lease terms. I think we can leave that for another day. Scott, but can you physically, like residential property, can you physically improve the value of a commercial property and get immediate upsides in terms of increased rents and or increased capital growth?
Yeah, there's many ways to do it. And like I'm working through a few of these examples for some clients as we speak. So one of them is we're building some hard stand or laying some hard stand out the front of a big industrial property. And we're going to amortize it was about like a 200 grand cost. So we're going to amortize that 200 grand into the lease value over a 10-year period. So it's increasing the rent, and it just allows a justification of that capital expense for the tenant's benefit. So we're going to benefit from the fact it's actually improving the property. It's going to be there for the next tenant as well. But it's going to increase the yield because we've put more rent on the lease. And that's just through an amendment. And this is where a good lawyer, like we obviously had a lawyer on our last podcast, but you don't stop working with your lawyer at settlement. They're there for your lease renewals. They're there for amendments. They're there for chasing up a late paying tenant as well. So you're kind of always going to be in touch with your lawyer. And that's going to come in handy when you're doing things like creative stuff like this, where you want to, try amend things with paper to make sure it's then going to be, actually attached to the lease forever in a legal way that a valuer can recognise that income.
So just quickly on hard stand. What is hard stand? Just so our listeners.
So basically, there's gravel out the front, which obviously is not attractive. It's not as good to store stuff on. It's dirty. It doesn't look good. So we're going to basically lay some concrete out the front, and that will allow a lot more sort of effective use of that space. So they'll just drop shipping containers and stuff like that on it, and potentially even put a structure on top of it in time as well. So that would be another layer to this conversation. Like you could then charge new rent for that shed that they build on top of it. So these things cost money, and you've got to then weigh up, is it worthwhile spending money on building a new shed, or do I just buy another one somewhere else and then
and this
come
the
back
question.
to it
It's
later?
like chucking a granny flat on a resi property, right? Like, is it 1 + 1 = 3? Is this hard stand initiative, is it tenant led, or is it owner led, as in, hey, I want to do this anyway, Mr. Tenant, if I do this, are you happy to pay a few more bucks a week on your rent? How does that work?
Most of them are tenant led. So, but you can prompt the tenant. You can even do this when you purchase the property. Like part of the due diligence we do for our clients is call the tenant up. Say, what do you need? How can we improve the property? Do you want to stay long term? Like, find out what they want. And then when you know what they want, you can then use that to create a win-win solution, because you want to hopefully keep your tenant for the next 20, 30 years if you can. And it might mean you've got to build an internal mezzanine or fit out an office for them, or part own a fit out for but you're going to get benefits to any money you spend. You don't just chuck cash at something and then, that's it. Like, you are going to be using this as part of a negotiation, and it might be as simple as getting them to sign a lease 3 years early, to take their 5-year option 3 years early. So it turns into an 8-year lease. And then that's a good time to call the valuer up. You've got the new lease in place. So you want to time all this stuff around your valuation as well to maximize the price. So solar panels are a big one at the moment. There's obviously the model that we sort of recommend is you can charge them like a 10% discount on their normal electricity bill, but you're collecting the 90% difference. So you can then reduce your outgoings on the property, and that can be capitalized into the rent. So any income you save, or call it make, through solar panel income can be increasing the yield, which will increase the price. So plus it gives the tenant a discount on it. So it is a win-win solution as well. You can instant asset write-off a lot of that stuff as well.
Yeah, that still exists.
Yeah, you talk. Yeah, I'd have to check the latest rules with it, but yeah, you talk to a specialist in that. So if you want to talk to a solar paneling guy, there's a million of them out there. You just reach out to a good local one. You can get referrals from your leasing manager. We can recommend people as well, but you just ask around, get a few quotes, just like any job, and that's going to give you an income benefit as well.
Really good insight, Scott. And look, we've just quickly gone through that solar panel thing. We could probably do a whole podcast just on that. So I think this is our headspace for the next period of time. All these post-settlement bits that you can do. We talk about putting on a mezzanine. I think that's a podcast in itself. All these little value adds, which are sometimes complex concepts, and execution can be difficult. And a lot of the times you've got to go, is the juice worth the squeeze as well? So how do you work out what to do and what not to do? So this should be our focus moving forward. I don't want to skim over this stuff. I think let's dig down into it. And so if you've got anything at all that you want us specifically to talk about, get in touch. It's info@rethinkinvesting.com.au. Is that correct, Scott? I've got that right? Yes?
Yeah, that's right. And yeah, if you want to sort of drill down into a specific topic, might need to get an industry expert, like a town planner or, like structural engineer or something like that to talk about specific things. But yeah, it's always important to weigh up the option. Like your granny flat analogy is the exact same we sort of talk about in commercial. I'm not the biggest fan of granny flats because I always think if you're going to sink whatever the cost is, it's probably 200 odd grand for a granny flat these days. That's a deposit for another house. You can then just go and buy something else somewhere else and sit on that for 20 years.
That'll try and fix a bit of a dodgy yield on a resi property. I completely agree. And you spoke also, I think we need to do a deep dive into is co-owning a fit out. That in its own realm is a complicated and complex, from a financial instrument point of view in terms of depreciation and capitalizing, amortizing costs around it. Like, I think we should do a full podcast just on that in itself, because when I know as someone has had commercial leases, they're pretty quick to put in front of you opportunities to pay for the fit out on the basis that they don't discount the rent. And you sit there going, and a lot of people take it, they go, oh, that sounds really good. I get $1 million, $2 million fit outs paid for by the owner. But there's a very good reason why they're happy to pay that and make sure they're giving you very little, if any, discount on the head rent, right? It's a very complicated and complex environment. And if you're on the ownership side, you probably want to know about these things as well. Is it worth actually paying for someone's fit out and keeping your rents high? And that sort of lends itself again to revalue and everything. Gets complicated, gets very, very complex. And I think we should dig into it. Scott, who's spending the most money in Europe at the moment? What sort of tourists you got there? A lot of Germans, a lot of Scandinavians where you are, no doubt?
So the island I am, it's led by the Dutch and Germans and English. They're the main big three. I was over in Rhodes a few weeks ago, and it was all full of Russians, interestingly, over there. So so they're obviously the big spenders in that island. But yeah, they're the main ones. It's just incredibly busy. If you try to fly around Europe, it's just probably 5 times the normal ticket price. So it's crazy. And the European economy is probably the worst in the globe from a rich country point of view. I'm not talking about some of the strugglers in South America and that, but like they're still going hard over here, which is interesting. Interest rates are quite low here, though.
On the Facebook, did I see you were in Bodrum? Did you go to Bodrum? You in Bodrum or your Rhodes?
So that's Turkey. So they're on the lira over there. I think the lira is crashing.
Yeah, back in my youth, I think I went. I've been to Bodrum. I think it's got Europe's biggest nightclub there. I don't know if it's still going. Halani Karnos. I remember it well. It's good fun.
Yeah,
Bodrum.
It's like the Turkish Vegas.
Yeah, it is like the Turkish Vegas. It's good. But who's the biggest nuisance where you are? Is it the English tourists are the ones who get most of the trouble?
Oh, probably your standard Australian who hasn't travelled much before. They're sitting in a piazza, hammered, first time off the plane. So
you still see them? They're out there.
Good. There's not many this year. Interesting. A lot of the Aussies are next year, I think, because we're still, getting back into normal life in Europe. It's a long way to commit, but next year there'll be a lot of Aussies.
I think we've all been that loud, obnoxious Aussie tourists at some point in our lives. So. Anyway, Scott, mate, good to see you. Next time back in the studio, I hope.
Yeah. So I'm getting on a plane in a couple of weeks. So see face to face, and probably go through more of these, the ownership of property. There's a lot of other things we can cover and go through it all.
And in terms of people want to have a chat with you, you're connected, engaged, you're happy, you still are sort of working with all your clients irrespective of your geographic location?
Yeah, well, look, we've got a big team. So I'm these days as well, just so the clients know, I spend 95% of my time just finding properties. So I'm not talking huge amounts to clients because I add more value by actually finding the assets and negotiating with the agents. So, and also helping with the due diligence. So got a really good team of sales guys that will put the time to understand everyone's situation and because everyone's different, everyone's got different risk profiles, and that I even post settlement, we're always there to help. That's a big part of my job too. Just this stuff we're talking about now, like what to do with releasing, how to get a tenant to sign a lease early, like when is a good time to sell. All that stuff is a big part of a good buyer's agent's job. And because you don't really get this advice anywhere else, I feel.
No, you don't. And we'll keep doing what we're doing. Scott O'Neill, Director at Rethink Investing. This is Inside Commercial Property, the podcast for commercial investing. And I think it's been, in many ways, opened a lot of people's eyes and a great awareness towards commercial investing, hence the reason why so many people in there right now. Thanks for tuning in, everyone. Please keep those reviews coming and those questions coming as well. We do enjoy what we're doing, and it's great to get that feedback to know what we are saying and doing is resonating. We'll see you again next time. Until then, bye-bye.